What is going on, everybody? Welcome back to Finance with Parks. In today's video, we are going to talk about inflation. This is the one financial metric that everyone has been talking about lately. We're going to talk about what it is and how it impacts you. Let's get into it. Welcome back to Finance with Parks. If you're new here, please consider subscribing. We try to post videos every Monday, Wednesday, Friday. We're just going to kick it right off. Inflation tracks the price increases of goods. Or really the way I like to think of it is just cost of living in general. I brought up this little tray here from downstairs, and this little box of goodies is going to represent inflation. So what we have here is we have Oreos, always a classic, and I brought it up here because I wanted to eat some. We've got a good old Bud Light, which definitely isn't open right now. We've got dish soap, and we have cuties and bread. I don't need to show you the other two. But what the inflation, or the best way I like to think of it is if you took all of these 5 items, a basket of goods is normally how it's said, and you looked at the price of these items last year in 2020. It's currently summer of 2021. Let's say they costed $3 combined. Now this year, they cost $4. So this box of goods has increased $1 year over year. That's what we would refer to as inflation, or the price rising or inflating. And now, that is an insane example. That would be 33% increase, right, of inflation. And what we normally see is about 3% a year. I'm going to go ahead and share my screen here. And this is the CPI index, or Consumer Price Index. This is really the number one thing when people think of when they talk about tracking inflation. So you can see here, change in average CPI is about, it varies by year, right? But it hovers around this 3% kind of time frame. You can see there are spikes here all the way up to 15%, which would be like a change in goods of a 15% increase year over year. And you've had the opposite in certain years, right? Where this box of goods may have decreased by 10% for this example in 1930. So inflation is really the change in goods, and let's talk about how it impacts you. Well, it has a huge impact on you, and it's very simple, right? It dictates how much you're spending at the grocery store. It can also impact things like gas prices, really just your cost of living increases. And so a lot of employees, you'll know, have basically given a 3% raise every year, right? And if you've ever wondered what that's for, that is to help offset inflation. The problem is it's kind of like this do loop, right? With the chicken or the egg is, prices go up by 3%. Well, we increase salaries by 3%, essentially putting more money out there in the market, and you're going to continue to see this climb of prices. So that's what it is. That's how it impacts you. Now let's talk about ways to management, or the ways that it spirals out of control. So right now we are seeing what we would call higher periods of inflation. I think last month we saw a 5% increase, which was pretty substantial, much higher than 3%, right? And from macroeconomic view, what causes that, and I'm putting this very simply, is more money in the market. If people have more money available to spend, and some of these goods have a limited supply, well, when the demand comes up, when you have more money to spend, the prices are going to follow that. And so let's think of what's put more money into the market lately. You've got unemployment. You have people getting stimulus checks. You have substantial amounts of government spending, which I don't want to call fake money, but at the end of the day is just printing paper dollars to keep the economy going, is going to end up catching up to you in a downhill effect as far as prices rising. You put more money into supply, it's just natural that prices are going to rise. Now there's 2 schools of thoughts with the current inflation. One is that it's just temporary, and there's almost like a bow wave, right? As the economy recovers from the pandemic, people get back to work, airlines get back up to full capacity, the labor force, there's a huge number of reasons. But they're essentially saying, yeah, there is going to be a slight tick up in prices for the time being until the economy can, quote unquote, catch back up to itself, because the recovery has been extremely fast. And some things just haven't caught back up to that. There's other schools of thought that say, Well, we've printed so much money and we've given out so much in unemployment that this really isn't temporary. This could last for the next, 3 to 5 years, and we could see a time where, things are just unaffordable at a certain point. So that's where people think inflation could go. Now let's talk about how you would fix that. And really the number one way to slow down inflation from a macroeconomic standpoint is to raise interest rates. Now, without boring everyone to death, I don't want to turn this into a, econ exercise because I've fallen asleep in enough of those college courses. But essentially, if you think about it from a logical standpoint, right, what's happening right now, if prices are increasing, interest rates are extremely low. It does not cost much money to borrow from the bank. And what does that mean? People can pay a little bit more for housing. When a mortgage loan is only 3%, you're only borrowing money for 3% interest. They're essentially giving it to you to spend for free. Now, if you want to slow things down, you want to bring back prices to what we could call like a more normal level, all you got to do is the Fed has to raise interest rates, and you will see those come down extremely fast. The problem is it's a very delicate balance, right? You want to raise interest rates to the point where you can slow down these price increases, essentially slowing down the economy. But if you raise them too quickly, people panic, stocks start selling off, and you can really have an economic crash on your hands in a hurry. So that is the problem that the Federal Reserve is in right now, is they're trying to find this balance of letting the economy run and fully recover before, pumping the brakes too soon. But also understanding that you can't just let price run out of control, because if things get so expensive to the point where no one can afford them, you're really going to see a hard crash at the end of it, when the rubber meets the road. So my last thing here would be, how can you protect yourself from inflation, or what would be my recommendation to try and best conquer this? So the thought is, if prices are getting 3% more expensive year over year, let's think back to like our parents, right? I remember we used to go to Rite Aid. My parents would be like, "Oh, back in the day, this was 65 cents for a waffle cone," and obviously those aren't prices anymore. It's like $3, and that's because of inflation. Well, so the best thing to be able to handle that, right, is one, getting those wage increases. Hopefully you're at a company that's increasing wages at a 3% rate year over year to help you with inflation. But the other thing is, if you're just sitting on your cash, let's think about this, right? If you have $100 and you put $100 under your mattress and you come back the next year, you still have that $100. However, prices have increased by 3% from last year when you had that $100. So it's really, in true terms, only worth $97. That, you don't want to do that, right? That's essentially losing money. So the best thing to try and combat that is to invest it. There aren't a lot of bank accounts or savings accounts now with interest rates so low that are going to be able to keep pace with that 3%. But my recommendation is always the S&P 500. The S&P 500 on average has returned about 10%. So even if you're seeing 5% inflation, the S&P 500 would still outpace that by a 5% margin. So you'd really be able to continue growing your money even as prices increase. So that's all I got in today's video. Hopefully that quick summary was helpful. I know I didn't go into a ton of the details, but this video is really to just give you a high-level understanding, because I know inflation has been a hot topic. So if you did enjoy this content, please like the video down below and subscribe to the channel. We would greatly appreciate it. Thanks again for watching, and remember, finance is fun. See ya.